Welcome back to the June edition of Happy Half Hour. That's Toby Weber. I'm Nick Shermans. Today is Tuesday, June 10th. The last time we were here was May something, and markets had bounced back. Now it feels more like a blissful environment. If April was hell on earth, May and June thus far have been a walk in the park.
It's almost like April never happened. Market was down 20% almost, and now U.S. market is flat to up 1 or 2% year to date. So we can almost forget about that 2-week blip.
What's crazy about the recent action, how quickly people forget. Where April was like the worst thing ever, and we're in the throes of a crisis, there's no end in sight. Fast forward, price action improves, and now folks are like, hey, that was an obvious opportunity, let's seek some more risk. Like I had a person wanting to go to all cash back in April, and at the end of May, they were talking about investing more in AI stocks. And it's a good thing we keep notes because I can point to this and say, hey, look, when markets were going down, you were looking to sell everything, and now 30 days later, we're looking to take more risk. That's exactly the type of behavior that we save people from.
Yeah, and you realistically, all we've done is kind of kick the tariff can down the road. So nothing's been resolved. I don't know if I've seen any trade deals announced. There's supposedly lots of discussion, meetings with China, etc. But that shoe to drop is still in front of us, and we're just waiting for the outcome of that to see the impact.
One thing I've been tracking is at the start of the whole tariff deal, there was a negative correlation between the number of trade policy articles out there. So the higher the number, there was a negative correlation to market action, meaning as more articles were out there, markets were reacting poorly. Now, the same metric is tracking the number of articles, and they're still there, but the market is reacting less to them. So I don't know what that means. It just feels like there's a bit of complacency. And to your point, it's hard to create these complicated trade deals involving billions and billions of dollars in 60 or 90 days. So you have to think either we're going to kick the can down the road again, or there's going to be some sort of tweet that says, hey, we couldn't get a deal done, XYZ is not acting in good faith, and we're right back to not square one, but back to the chaotic action that we saw in April.
Yeah, and maybe that's a good jumping off point for my first question for you. I know we're not prognosticators. I know we don't have a crystal ball, but any guesses as to how this tariff situation plays out? Trump has made noises about maybe softening his position. You know, the initial menu that he showed, the Denny's menu that he showed that had tariffs for every country that were much higher than people thought. You know, he's softened his stance a little bit perhaps on that, but any guesses as to how this plays out, or you don't really look at it that way?
I don't know how it plays out, but I can tell you there was a narrative that President Trump didn't care about what markets were doing. And I think he very much cares about what markets are doing. He's a business person. Many in his cabinet are business people. They've worked in markets. They understand how markets work. And many Americans are investors. That's one of the things that bring us together. The economy, markets affect most of us. So that's common ground. It's a conversation point, even if you're just meeting a stranger for the first time. So I think that very much matters to President Trump. And he received feedback that the market did not like a lot of his rhetoric around trade and tariffs. And I think that's in the back of his mind. And now I think he'll tread a bit lighter as he publicly announces trade deals, publicly announces trade policy, because there are certain things the market doesn't like. There are certain things that the market does like. And I think that has become crystal clear to him and his cabinet.
Yeah, I think I see it the same way, that he's unlikely to go scorched earth with this tariff discussions. I think he understands there's some nuance that needs to be involved. And I think getting a trade deal with China that works for us and that he can claim is a bit of a victory would be very important. And then maybe this becomes kind of back page news moving forward as the details get worked out. But we'll see what happens and how that impacts the second half of the year.
Markets aren't stupid. They very much pay attention, and they've almost discounted, back to my earlier comment about the headlines really not driving the price action now. Markets will move on. Markets tend to look forward on the next potential thing. And I think markets have captured this rhythm of coming out really aggressive and then slowly backing off. So the next wave, the next time this happens, markets are going to discount that and not react, in my opinion, as aggressively as they did back in April.
Okay, this isn't a softball. I know you like softballs. You get to pick whether you want to comment on AI or Bitcoin? These are two technologies that, are top of mind for a lot of people, a lot of investors, and they seem to be changing in some respects at a pretty quick pace. What has jumped out at you, or what have you been reading relative to either AI or Bitcoin as of today?
Well, I just wrote about Bitcoin. Many of our clients own Bitcoin. I feel like I've said all I needed to say on Bitcoin. And again, I'm not pounding the table on Bitcoin. I just think it's very intriguing asset class, and a lot of the trends, how the SEC is adopting it. Countries are talking about a Bitcoin reserve. Companies are putting Bitcoin on their balance sheet. Like, all of these things are mind blowing to me. I didn't think I'd ever see them in my lifetime. So I think Bitcoin's on the fast track to becoming a mature, accepted, institutionally adopted asset class. It's not there yet, but it's coming. The AI stuff. I've gone down the AI rabbit hole, both to utilize AI in our business and also as an investor. There's a few themes that stick out. One is AI changes very, very quickly. Where we were at the end of 2022 to where we are now with the various models, the data sets AI is pulling from, the reasoning models, it's changing at breakneck speed, which is both good and bad. The second thing that sticks out is governments have been very slow to react and regulate, which could be a problem. There's evidence that bad actors are using AI for not so good things. People talk about the robots taking over and they could wipe out 10% of humanity. Like, all of these things are impossible to quantify. And look, it's not like government's job is easy either. Like, again, back to my first point, it's moving very quickly, but there needs to be some agreed upon framework for what's legal and what's not legal, what data is being pulled from. Like, I just was on AI just now, and one of the prompts that I asked was pulling from a blog of another company that I follow. And I'm like, well, that's kind of stealing the information from this guy. And that's just one example of how AI is kind of the Wild West. And then the third thing, and I've said this before, every presidential race that we've had since I've been alive, I'm 43, jobs, economy, wages are front and center. The AI promise is it's going to make businesses more efficient, but also get rid of headcount in jobs. I don't see how that's good for humanity to have 30% of our jobs going away. So that goes back to my second point. Government needs to regulate this. We need to understand it better. There needs to be guardrails on how AI develops, because folks being out of work, folks not having any purpose in life, that's kind of breaking the social fabric of everything that we've known.
I think that's fair. What about investment implications on the AI side? Is there anything people should be thinking about in terms of investment? I know in our client portfolios, we have ETFs that own a lot of the top AI companies, but anything specific that investors should be thinking about relative to AI today?
I think as a hedge to everything that I just mentioned, it would be prudent to own the robots. Like, that's one thing I keep coming back to. If you're worried about AI taking your job, if you're worried about AI bad actors or AI running roughshod, it makes sense to get on the train and own the robots. However, I think you need to be mindful of position sizing. I keep saying that. I sound like a broken record. You can't get over your skis. It's a very volatile space. Look no further than April. And then one thing that I've also keep coming back to is these companies have invested billions and billions of dollars on AI. At some point, investors are going to want a return on that capital. Right now, there's no AI model that is working, that's a profitable business model. Right now, it's all full send investment. I just saw that OpenAI hit $10 billion in revenue, but they lost $5 billion last year. That's not a sustainable equation. And then you layer in like the energy consumption and all of these things, the infrastructure, the data centers. It's a promising technology, but again, at some point, investors want to see a payoff. And right now, we're not close to that. Like, I just saw a report yesterday that I think a major bank, it might have been Goldman Sachs, was like, hey, the hard data is not that bad. The soft data is getting better. I mean, what do you make of that?
Well, I think it's interesting that the economy so far seems to be very, very resilient. We kind of went through this a couple of years ago where everybody said, well, clearly the recession is coming end of the year. Well, maybe it'll be next year. And it never really materialized. And it's too early to say we're out of the woods now. But the hard economic data has been very good, very resilient. A small uptick on the employment side, but still near all-time lows in terms of unemployment rate. So I think we have to wait until the hard data starts to shift and signal change before we can think that we may be in trouble from an economic standpoint. But I think everybody's trying to predict the next recession, and it just seems elusive, and the economy seems to be holding in there pretty well.
So is it fair to say that predicting a recession is hard?
It's a fool's errand, as they like to say.
And it's funny too, because government can't really agree on what a recession is. This is the ebb and flow of an actual recession. Markets go down because markets are the best recession predictor out there. Markets go down. Government calls a recession. People are still freaked out. Then the market sniffs the green shoots, sniffs the better days ahead, and it ends up ascending around when the government actually calls a recession. And that's just Johnny come lately. The government's not very good at calling recessions.
Yeah, and wasn't it going to be that when they announced the tariffs, that there were ships coming to the United States that were going to be empty, and that was going to be the onset of the recession? And I haven't seen any updated reports that happened. Now, again, none of this means that we're out of the woods. We were shopping for a car over the weekend, and the car dealers are all like, we're not getting any more cars because we have to figure out how this tariff situation gets resolved. So feel free to pick from the cars we have on the lot because we're just not bringing in more cars. So it tells you that there's certainly some uncertainty in the market today, but none of that necessarily equates to a recession.
Yeah, and back to my Goldman comment with the hard data and the soft data. The soft data is getting better, in my opinion, because markets have snapped back. Price drives sentiment. I say that a lot, but I think it couldn't be more true. And this recent bout was an example that when markets are down, people are going to feel worse. They're going to spend less money. When markets go up, people start to feel better, and it takes its shape in many different forms. Soft data is one. Investors wanting to get more aggressive is two. So folks need to be mindful that investing is not you hunker down when things get uncomfortable and you seek a bunch of risks when things seem blissful. That's a recipe to get absolutely crushed. So just be mindful of some of these biases. I say that folks got a mulligan from April to May. Markets don't usually bounce back that quick, but it's happened twice in the last few years. Think COVID and think just this past month or two. And that's more the exception than the rule.
In the last couple of months, we've kind of done a segment where what is your favorite Trump proclamation or idea that he had? We're going to shift that this month. I wanted to see where you came in on the heavyweight tilt between the world's richest man and the world's most powerful man that erupted on Twitter last week with all sorts of name calling and accusations. What was your take from that, other than hard to believe your eyes?
So to be candid, I was out of town during that, and I was trying to ignore my phone and everything. But I did hear about it. My wife actually brought it up. And from my personal standpoint, if I'm Elon Musk and I'm tasked with reducing waste, fraud, and abuse and spending in the government, and then they launch this bill, which adds to the deficit. And look, people want to talk a lot about this bill. I'm going to go off on a tangent for a minute. We're already at a $2 trillion deficit this year and last year and the year before. This is not like we're on sound fiscal footing and this bill is going to screw everything up. Things are already screwed up. This is very much a two-party problem. If you look since 1995, we've added to the deficit under presidents from both sides of the aisle. Congress is culpable. We're at $36 trillion and counting. So let's not act like we've had our act together and then things are going squirrely. But back to Musk. I personally would be pissed off if I'm tasked with cutting waste from the government and fraud and spending and all that. And then this bill launches, which just adds to all that. And then I'm being fought every step of the way for cutting. And look, I'm not saying that everything that was cut was appropriately cut. Certainly when you move fast like Musk does, I encourage folks to read his book. His whole mantra is cut everything to the bare bone and then add back. That's what he was trying to do. He hit a dead end. Then this bill comes. I understand his frustration, and good for him for speaking out. That shows to me he's an independent thinker, and I know he's caught a lot of arrows, and whether you love him or hate him, the guy's not an idiot. I mean, he launches rockets to outer space. Every country on Earth would want an entrepreneur driving some of the most innovative companies on planet Earth in their borders. And so, I mean, I understand some of the arrows, but I also don't understand some of the arrows.
So you're not on board with the big, beautiful bill that's working its way through our government?
I can't pretend to read or know everything about the big, beautiful bill, but if recent history is any precedent, I can imagine there's all sorts of things in there that don't really matter to the American taxpayer.
I think that's fair. And I think part of Musk's frustration stems from the fact that the EV credits that he's enjoyed or his company has enjoyed are likely going away if that bill gets passed, and that could be material impact to Tesla and their financials. So I think a little bit of it is concern about that, but certainly interesting when those two go at it.
I've got a question for you. What's your favorite asset class? This is personal. Favorite asset class or stock, I guess, that you're currently watching but you don't own? And maybe don't talk about a stock because our compliance will get mad at us.
Asset class that I don't own. So one that I'm positive on.
Yeah.
I would say the asset class is probably energy, oil-related products. I would tend to think if we look 5 years out, oil prices are higher than they are today, but I don't currently own any investments or any significant investments in the oil sector. So that'd be one asset class that I don't own. I'm pretty diversified, so there's not a lot of options to pick from of things that I'm not already invested in. How about you?
I pretty much own everything that I'd want to own. I don't overthink it. If I get money, I just invest it. But okay, here's the next part of that question. If you had a chunk of money come in and you needed to invest it, but you couldn't invest in the equity market, where would you allocate that capital?
Time frame, objective,
20 years, set and forget.
probably managed futures.
Really?
Yeah.
Okay.
How do you like that one?
I didn't expect that.
So yeah, I would put it in managed futures and kind of set it and forget it. Not worry about it.
For our audience that might not know what a managed future is, can you talk about that?
Managed futures are funds that are buying a variety of different asset classes and using trend and momentum type rules to decide which ones are in favor to buy and which ones are to be ignored or not purchased. So it's kind of a trend and momentum vehicle, which is what I like about it. But it's kind of complex and kind of hard to understand and kind of opaque. And so that's why we don't, buy that investment class for our clients.
I got another question for you. What's the most common egregious mistake you see in prospective client portfolios that come to us from other advisors? Like if there's a common theme.
Good question. I think I'm still blown away. We had it happen recently. Clients that come in and really don't have prospects come in and don't really have a clear understanding of the costs of the investment program that they're on, why they're on the investment allocation that they're on. And so you ask questions about their setup and they quite frankly don't have the answers, which is fine. I mean, that's why you hire an advisor to hand that off. But if it were me, I'd still like to understand why we're doing certain things. And I certainly would want to understand how much I'm paying for the help. And unfortunately, when people don't know how much they're paying, when you find out how much they're paying, it tends to be higher than it should be. That's obviously something that's near and dear to our heart at Pure, emphasizing low-cost investing. So those are two of the things I see, not understanding what they have, and then two, not understanding what they're paying. How about you? Same question.
So in that same spirit, I'm always baffled when someone is really obsessed with external factors they have no control over, what the economy does, who gets elected, what the market does. They're hyper-focused on that, but they're not focused on the things they can control. And to your point, a lot of the prospective clients that come to us are paying an advisor over 1%. They're invested in mutual funds, which add another 0.5% or 1%. Those mutual funds aren't tax efficient, so they're lighting money on fire, paying taxes that they don't really need to at the end of each year. They have zero clue about the risk management within their portfolio. They don't know where the landmines are hiding in their portfolio until it's too late. So all of these things are just sound investment principles, focusing on the things you can control. And then if you want to layer a framework to make decisions going forward, that's great. But good investing is often optimizing the things that you can control. And I think you should start there first before you look to external factors. So that's one thing that really drives us at Pure. There's good advisors out there. There's more very poor advisors out there. And we see it almost every day with the portfolios that come across our desk, just by harvesting the low-hanging fruit, as we call it, optimizing what we can control. I think that gives people a higher probability of a good outcome.
Yeah, and I think, as you said, it really is an opportunity for us at Pure because it doesn't do us any favors to put you in an investment program that you don't understand. And so we really emphasize transparency and really explaining at a detailed level why we're buying the things we are, what the exposure is, and what the cost is to get that exposure. And I think if I can't do a good job of explaining it to a client in a way they understand, then I'm really not, not doing my job, because it doesn't do us any good to have such a complex investment program that people don't even understand what they're doing. We know they trust us. We know they want to work with us, but we want them to be on board for the ride.
Yeah, if you can't explain it to a 5-year-old, it's probably much too complex. With that, we're going to put a bow on June's version of Happy Half Hour. That's Toby Weber. I'm Nick Shermans. If you have any questions about our investment framework, the way we work with clients, shoot us a note at insight@pureportfolios.com. We'll see you next month.
Cheers.